Good morning, everybody. This is Chris Robinson, Robinson Ag Marketing with today's pre-opening grain comments. Hey, if you want to call me, give me a call, 312-638-8868. Go to Robinson Ag Marketing, sign up for my letter, take a look at it. You can look at it month to month. Let me know what you think. If you're looking for fresh eyes with your marketing plan, take a look at what I offer. Overnight March corn, a 3 cent range, finished at 4.45 and three quarters, down three quarters of a cent. Again, 447, 448. That's what we got to get above that 200-day moving average. I know I sound like a broken record, but that's where we're at. March beans down 8 cents, 1094 and a half. Looking at spot beans, the Jan. We're right back down on it, guys. 1081. We're back down on those lows. 1084. It looked like a little bit of Chinese buying had some people being brave enough to step in and buy it. We are going to test the low of the move here. That was 1081 and a half. We're trading at 1084 and a half. There's a gap down there, ladies and gentlemen, which gets filled at 1062 and a quarter. So if you ask me, hey, what's the risk here? Well, very easy. The risk is we break 20 cents and fill that gap. These chart traders like to fill that gap. And that's kind of where we're at. We've got to the point now where China's probably bought 7 to 7.5 million metric tons of the 12 that they promised us. That's great. It's still half of what they bought for the last, decade and a half. And yeah, they've promised to get back to normal, but a promise is a promise, right? It's a memorandum of understanding. And so this is what we're going to be slogging through, kids. So defend what you can. I don't think there's going to be a ton of risk until the January 12th report. And, when we're looking right now, new crop beans are now under $11, back to 1091. We had gotten to as high as 1133. You don't want to be back down at 1048 where we were on October 1st without a hedge. March wheat, Chicago wheat, KC wheat, all lower overnight. Argentina's crop got bigger. That's the fundamental news out there. And obviously, we all know that Argentina's government lowered the tax for farmers to sell their grain. So that's putting more pressure on the wheat market, which already has a lot of pressure. We're 25 cents from new contract lows. So when there's 25 cents worth of risk, do you want to have a 40-cent put on the books? No. If there's 25 cents worth of risk, keep it to 6 or 7 cents. But for goodness sakes, have a plan if we start making new contract lows. I hope we don't, but I want to at least defend the contract lows. Minneapolis wheat, same thing goes there. We're trading at 573. I think as Chicago goes is really how spring wheat will go. And back to the cattle and the livestock. We've had a tremendous recovery. We've had basically anywhere from a 40 to a 50% recovery of the collapse that we had. What do you mean, what collapse? Well, feeder cattle dropped 85 bucks. Fat cattle dropped 45 bucks. Lean hogs dropped about 14 bucks. We've now clawed back close to half of that. So if that revenue is worth anything to you, set a hedge. And setting a hedge is not getting bearish. It's just protecting revenue, guys. I can't stress that anymore. As far as rolling puts up, people are like, oh, I hate puts, Chris. I hate puts. Here's a scenario, and I'll let you go. March feeder puts. I'd had 290, 270 put spreads on. We had them down there kind of as a disaster put in case we took out $3 for a long, long time, right? So we spent $5 to try to make 20 if the market collapsed. So it was a defensive position. Now those 290s, I was able to roll those up to 305. I was able to roll up 15 bucks, and we did it for $2. Now, call me crazy, but I think I'd rather spend $10 to move my floor up 15 than to have been short futures and made margin calls for $40. That's why hedges in a market like this, if you use long options, can be a better strategy. Yeah, you lost your initial $5. I think when we looked at this spread, it went from $5 to about $2, right? So the spread was still worth $2. So on a $40 move, you lost $3 on that spread. And then now you get to say, do I want to spend another $2 or to move my floor up 15? That's what working with somebody that understands how to roll options, and get you in a better position. If you could spend $2 and pick up $15 higher floor, I don't know on what planet that's not a good hedge. That's not a good roll. Yeah, there's a cost associated to it, but I think it's less than if you were short futures and made $40 worth of margin calls. And at the end of the day, if you're a rancher, you're long the animals anyhow. You want prices to go to the moon. You want these hedges there to protect you for when we do drop, uh, $85. It's crazy. Or we do drop $45. So that's the key. We dropped 85, we clawed back, 45. We dropped 45 in the fat cattle, we've clawed back, 25 or 30. So on that note, I'm going to tell you that if you've got options on, and then that's the other problem with the LRP stuff. You're stuck with them. You can't roll them. You can't move them. At least with the CME options, you can roll them. All right. Give me a call, 312-638-8868. No one's perfect. I'm not perfect. But if you're looking for help with your marketing, give me a call.